Welcome to the Deep Dive. Today we're switching gears for our special feature, Talk Tickers, where we pull you out of the conference call weeds and get right to the critical insights.
And today we are digging into the Q3 2025 results for Aquestive Therapeutics. This was arguably one of the most pivotal quarters for them in years. It's really setting the final stage for their flagship product, Anaphylm.
That's so true. This isn't really a deep dive about their legacy revenue or anything like that. It's all about regulatory confidence and, well, cash burn.
Exactly. This Q3 call, which came out in early November, it just felt like the final setup quarter before this huge binary event.
The FDA decision.
Yeah.
So we're here to help you navigate management's, immense confidence, understand why their losses might actually be a good thing right now, and map out what is a very, very dense catalyst calendar ahead.
All right, so let's jump in with the headline financials. At first glance, they look a little messy. GAAP EPS missed consensus by just a single penny. They reported a loss of 14 cents versus the 13 cents that was expected.
And revenue was also a slim miss.
A very slim miss. 12.8 million reported versus a 12.9 million consensus.
Okay, so on paper, it's a technical miss.
Yeah.
But you really have to dig into that revenue number to get the full picture right.
You do. The company's core base business, manufacturing agreements for products like Sympazan and Suboxone, that part is stable. If you adjust for a one-time thing, some deferred revenue from last year, core revenue was actually up 4% year over year.
That stability is the foundation, but it's not the story. The real story here is the financial drag, and it's on purpose.
It is. The net loss widened pretty substantially to 15.4 million. That's up from about 11.5 million in the same quarter last year. And the non-GAAP adjusted EBITDA loss grew to 8.6 million.
Okay, so that widening loss is the headline, but you're saying it's intentional. It's a calculated investment. But I have to ask, is this sustainable? Selling general and administrative, the SG&A, jumped from 12.1 million to 15.3 million. That is a huge jump in spending.
It is a massive increase, but management is deliberately front-loading this. They are spending the money now to build the infrastructure they need to launch what they believe is a blockbuster drug in Q1 2026.
So that SG&A spike is all pre-launch hiring and regulatory costs for Anaphylm.
Almost entirely. It's commercial leadership, it's medical affairs, it's the legal costs that come with a new drug application, an NDA.
So they're treating this Q3 cash burn as necessary working capital. They believe that if Anaphylm gets approved, this spending will pay for itself very, very quickly in market share.
Precisely. And they're so committed, they actually held their full year 2025 guidance for that non-GAAP adjusted EBITDA loss steady. It's still at 47 to 51 million, which explicitly confirms these huge pre-launch costs were already baked in.
They're betting the farm.
They're betting that Anaphylm reshapes the category, and this is just the price of admission.
Okay, let's pivot then. Let's go to the regulatory side.
Okay.
Because if all the money is flowing towards Anaphylm, the regulatory status is the real measure of their confidence.
Right. And as a reminder, Anaphylm is their needle-free epinephrine sublingual film for anaphylaxis.
And the PDUFA date is still firm.
Still firm, January 31st, 2026. And for anyone listening, the PDUFA date is basically the FDA's final deadline for a decision on that new drug application.
And what stood out on the call about that? What was the signaling?
The single most critical piece of news, I think, was that the FDA has declined to hold an advisory committee. An AdCom.
Wow, they declined an AdCom. That's not just positive. That's a major, major de-risking event for a company like this, especially for a new delivery mechanism.
It's huge because the FDA usually calls for an AdCom when a drug is really complex or raises new safety concerns or it's controversial.
So by declining it,
it's the clearest sign management could get that the clinical data is strong, the review is going smoothly, and the agency just doesn't need external input. It strongly suggests the FDA reviewers have a clear path to approval.
And they also shot down any worries about government shutdowns or anything delaying the timeline.
Yeah, they did. They confirmed they are targeting an on-time review.
That confidence seems to be translating directly into their commercial prep. I mean, they're not just waiting around for the decision. They're building momentum right now.
They absolutely are. They've started hiring district managers. They had a huge presence at major allergy conferences like ACAI. And their internal research is it's incredibly compelling.
Tell us about that research.
So they did these internal surveys and found that 33 out of 35 clinicians preferred the Anaphylm film mock-up over a competitor's nasal spray.
33 out of 35. That's an incredible margin.
It's a massive preference. It really validates the whole product concept. Needle-free, fits in your pocket, it's discreet. That kind of feedback has to be what's fueling this aggressive launch plan.
Okay, but in a high-stakes field like this, you're always going to get competitive pushback. They got questions about a competitor's citizen petition, right? Which is basically a legal move to try and slow things down.
And they just swatted it down. Hard. Management was really forceful, calling the petition factually incorrect. They see it less as a real regulatory threat and more as just a desperate defensive move.
So in their view, it actually proves how worried the competition is.
That's their take. They expect zero impact on their PDUFA timeline.
Now, on the huge question of pricing, they were pretty tight-lipped on the wholesale acquisition costs, the WAC.
As they should be right now. Pricing is so strategic. But they did emphasize a patient-first, responsible pricing approach.
Meaning what, exactly?
Meaning they're aiming to be competitive relative to EpiPen generics and the nasal sprays. The goal is broad access, so they need to get on those formularies. They hinted that things like cash pay options and copay programs would be a big part of the strategy.
So patients don't get sticker shock. Critical for uptake.
Absolutely.
Okay, so they're burning all this cash to get ready. That brings up the big $129 million question. What does the financing runway look like?
This is where they look exceptionally strong. They seem very well capitalized to handle not just the launch, but the ramp up after.
And how did they build that capital base?
Well, they executed a successful $85 million equity raise. That's a clean cash infusion.
Okay.
But more importantly, they structured a $75 million commercial launch facility with RTW Investments. That facility is contingent on FDA approval, and it secures their funding needs well into 2027.
And their liquidity right now is strong. They ended Q3 with what, $129.1 million in cash?
Yeah.
That is some serious insulation.
It is. And on top of that, they're actively refinancing their existing debt. That's a condition of the RTW facility, and they expect to announce a new debt partner before the end of the year. It just locks everything in.
So turning from the balance sheet, let's look at what's next, the pipeline. It seems like they're already seeding the next generation of growth now that Anaphylm is pretty much funded.
They are. They're reaccelerating what they call the AdrenaVerse platform. And the first real move there is with a product called AQST 108.
Which is a topical gel.
A topical gel for alopecia areata. They've already completed their pre-IND meeting with the FDA, and they are moving surprisingly fast.
How fast are we talking?
They expect to start a male safety study in January 2026, which will roll right into a 24-week phase 2A trial. This shows they are already deploying capital to create the next catalyst for the stock, assuming Anaphylm is a success.
And this whole strategy extends globally too, right? They're not just betting on the U.S.
Exactly. The international plan for Anaphylm is moving quickly. Health Canada has already said no additional clinical studies are needed.
So they can just file.
They expect to submit the paperwork in the first half of 2026. And crucially, they're expecting feedback from the EMA on the European pathway in early Q1 2026. That sets them up for some potentially lucrative out-licensing deals.
So what this all points to in the investor context is that fundamental pivot we keep talking about. They're shifting from a predictable, stable manufacturing business
to a high-growth, high-margin, branded specialty pharma model. The base business is the insurance policy, but Anaphylm is the growth engine.
And the market dynamics seem to support that pivot.
They do. Management pointed out that the overall epinephrine market is growing. Prescription data showed 8.8% growth in Q3. It's a rising tide.
But here's the kicker, right? 95% of those scripts are still for auto-injectors. That is the behemoth that Anaphylm is targeting with its whole needle-free, pocketable differentiation.
And that brings us to their commercial strategy, which is very focused. Instead of a big, expensive, splashy, direct-to-consumer campaign, Super Bowl ads, they're being much more disciplined.
They're targeting the high-volume prescribers first.
Exactly. They plan to layer in that mass consumer awareness stuff later on.
But wait, isn't that a bit of a double-edged sword? If you only use a small sales force of 50 to 60 reps, are you leaving too much on the table? I mean, if competitors are running those big TV ads, won't Anaphylm risk a really slow initial adoption?
That is the core risk. Their bet, though, is that allergists are the most capital-efficient target. The average allergist writes 200 or more epinephrine prescriptions a year.
So capture them first, and you get the biggest bang for your buck.
You win the high-volume players efficiently, you generate clinical buzz, and then you spend the big money on general awareness. It's capital preservation over a fast, expensive splash.
It's a disciplined approach.
Yeah.
But is the market buying it? Is it rewarding this confidence? The shares popped right after the call, I think up over 2% at the close, but they hit an intraday high of plus 14%. But since then, they've kind of drifted lower.
That drift really highlights the skepticism out there. It's about launch execution and getting payers on board. Even with all the management optimism and analyst price targets between $8 and $10, investors are still cautious.
It's a high beta binary event stock.
The market needs to see proof. Proof the commercial strategy works and proof that payers will cover it.
Which brings us to our segment we call This Is Not Financial Advice, where we outline an outrageous but plausible trade idea designed just to illustrate the risk profile of a stock like this heading into its PDUFA date.
Right. So given that the PDUFA date is January 31st, 2026, the implied volatility in the near-dated options is peaking. Premiums are really inflated. So our idea is a classic volatility capture play. It's designed to fund a long-shot directional bet on management's confidence.
The strategy is a risk reversal. We're basically capitalizing on those inflated premiums by selling protection and then using that money to buy some huge upside leverage.
So to execute it, you would start by selling an out-of-the-money January put. For example, you could sell the $4 strike put. You get a nice credit for that because you're taking on the risk that the stock collapses before the decision.
And then that credit, that premium you just received, is used to finance the purchase of much cheaper out-of-the-money February or March calls. Let's say the $10 or $12 strike calls. You're buying a lottery ticket with the insurance premium you just collected.
Exactly. If Anaphylm gets approved, the stock could easily surge past those $8 analyst targets. Those cheap calls could become major winners. You get huge leverage with very little initial cash outlay. Now, if the approval is delayed or rejected, you keep that premium.
But you risk being assigned on the puts.
Meaning you would have to buy the stock at $4 a share, which would likely be a significant loss. But it's a pure, high-leverage bet on that PDUFA outcome.
It's a structure that perfectly mirrors the binary risk of the next few months.
And just to be crystal clear, this is a very high-risk structure. It assumes management's confidence in their regulatory process is 100% warranted.
So what does this all mean for you? Q3 was, without a doubt, the crucial setup quarter. The company is fully funded through launch. The regulatory signals look very green, no AdCom, an on-time review target, and they are building that focused commercial team ahead of the January 31st PDUFA decision.
The key takeaway here is that strategic pivot. They're using their stable core business cash flow to fund a potential multi-billion-dollar game changer in a market that's growing. The upcoming catalysts, the PDUFA decision itself, the initial launch numbers, the first data from that AQST 108 pipeline, those things will define this company's valuation for years to come.
And our final provocative thought for you to explore is this. If Anaphylm is successful, will that differentiated commercial strategy focusing only on the high-prescribing allergist at first allow them to scale fast enough to hit those aggressive market share targets the analysts have baked in? Or will the competitive pressure from auto-injectors force them into that massive, expensive TV ad campaign much sooner than they planned? Thanks for joining us for this deep dive.